Been watching my videos for any length of time, you know that I love trade businesses like HVAC, electrical, roofing, home remediation, and the like. I also like mission critical business like accounting, engineering services, things that people need. So, but in today's video, I'm going to do something different. I'm going to talk about one specific industry, which is HVAC, which is really popular. And I want to tell you how we go about the whole process from A through Z, how you can actually acquire a profitable HVAC business. Let's get to it. Hey everyone, welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy and scale a profitable business. Small business and want to increase your wealth by buying a profitable business, or a W-2 employee looking to get out of the rat race by buying a profitable business. In either case, you're in the right place. Please subscribe to my channel. Don't forget to hit the bell, and you'll be notified every Thursday when new content comes out. I'm going to try to make it as quick as I can. These are 8 steps that you need to buy a profitable business. Number 1, you need to understand the HVAC industry. A lot of people coming into the industry just think they can just walk in, talk to a seller, talk to a broker. You're going to know the lingo, and they're going to accept your offer, whatever that may be. That's the farthest thing from the truth. You need to understand the key statistics and the market size, the current trends and the future projections, the types of businesses that are HVAC. For instance, I have a business right now for sale. It's a specialty HVAC business. They're doing about $6 million in revenue, about $600,000 worth of SDE. It's a very specific type of industry that caters to commercial clients. You need to understand that. So you're either going to go into residential or you're going to do commercial. What do you want? What is your expertise? How can you bridge the gap in the management experience? Is it going to be service-based or product-based? You know, I like retainer type models in which you have, year over year, month over month recurring revenue. Whatever the mix and the model is, you need to understand that. You need to understand how the game is played in the HVAC industry. Because if you know the KPIs, if you know the rules of thumbs, you're going to be able to compete. But at the very least, you're going to be able to have eloquent and smart conversations with both sellers on off-market situations and business brokers if they're representing the listings. Number 2, finding the right HVAC business. Now, this is deal sourcing. So deal sourcing it's a matter of understanding. If you really narrow it down as to whether you're going to be residential or HVAC, well, the owners of those businesses hang out at different places. Now, you need to understand what industry trade groups they hang out to, who are the vendors, what conferences they go to, what trade associations they belong to. So you want to go where they hang out. Now, I particularly like going into off-market situations because I want to make sure that I'm having those early conversations long before they engage a broker. Because once they engage a broker, you're out of the loop. You have no conversation. They become the gatekeeper. They get it under contract. Then you have to go through the broker to get to the seller. So, but if you are hanging out with them at the right place as they begin to think about buying a business, then you're having yourself a conversation. So, it's about, what I recommend is a bifurcated approach when it comes to deal sourcing. Number 1, you want to be on market because you want to know what's going on in the market. Yeah, you can start with Biz by Sell, but there are hundreds of websites. There are websites catering to online businesses. There are websites catering to lower middle market. There are websites catering to Main Street. There are websites catering to fulfilled by Amazon. There are each and every one of the franchisors, the Murphys, the Transworld, the business teams, all of the major players have their own websites with their own inventory, with their own version of the MLS. So if you're trying to go to market and trying to find anything that walks with the SDE that you want, you're wasting your time. You're going to come out, you're going to get burned, and you're going to be the statistic of the 90% of buyers who don't buy a business. So you know me, I like to shoot it straight. Number 3. Now, number 3 and number 4, I'm going to do an overview with you online. Okay, so step 3, evaluating the deal. Now, to evaluate the deal, you need to really look at financial statements and tax returns. Understand the seasonality of the cash flow operation. You need to understand what's going on with the service agreements on an HVAC, right? Quality and condition of the equipment and the vehicles, the market and competition, analyzing the market size and share in a competitive landscape, evaluating customers' reputations and reviews and reputation. So particularly on the numbers side, I don't really begin to analyze anything until I have tax returns. Now, these numbers are predicated on me having tax returns, and I come up with an SDE factor and an EBITDA factor. So we calculate the trending 3-year average, and then I go figure out what the multiples are on a sample. I have to have a large enough sample on same like revenue and SDE and EBITDA to compare what I sold in the past. So I have 82 transactions that had traded for EBITDA as a multiple of 4, which means half the businesses that sold for 4 times. That's a conservative valuation. 75% sold for 5.6 times adjusted EBITDA. The average SDE was 3.2 across 90 businesses. So half the businesses, the median was for 3.2, 4.1 on the high side. So if I want to make a conservative valuation of the business, then I want to say, what is the median? It's 3.2 and 4 times. Now, could I go higher than that? Yes. So I take the average 3-year SDE and the average 3-year EBITDA times the multiple that I get from industry-specific software that we use, and that gives you a ballpark. If there's real estate involved, then we have to factor that in. So there is there are common valuation methods. I'm surprised that a lot of brokers actually use basically asset-based valuations. Now, if you are practicing M&A, a broker or M&A advisor, there's only one way that you will value a business, and that is the multiple of the cash flow that it produces. The assets are irrelevant so long as they produce the kind of cash flow that we want. But when you're not buying the really assets, otherwise you buy them at a fire sale. If you're buying at the doorsteps of the courthouse, when you buy assets, the assets are irrelevant, and maybe they even may be fully depreciated. What you're really buying is a cash flow stream. The assets are only helpful if they're producing the cash flow that we want. We're going to measure the deal on cash flow. The bank is gonna value this business on cash flow. They're going to look to see what is in the balance sheet that is not fully depreciated. So, for instance, when the lender is going to value the business, they're going to be looking at things, what is the age and condition of the equipment? Has it been fully depreciated? How much useful life is on the equipment? The stability of the quality of earnings is first and foremost, and the customer base and recurring revenue. You may have a business that is doing $500,000 worth of SDE with 2 customers. So what is if one of them goes away, there goes 50% of the revenue and the cash flow. So those are the things that we do when we're analyzing a business. We look at hard data. This is not a pie in the sky. This is scientific calculations that we have to do in order to arrive at a point on a price that can be defensible. It's all about having a defensible valuation that will stand the test of time, and it will not fall apart under financial due diligence, legal due diligence, and the bank looking at it to finance this deal. Because remember, the bank may give you up to 90% of the value of the transaction, and you're coming up with 10%. Now, who is at most risk? The bank. So the bank is want to make sure. So what we do is we really look at any deal as through the lenses of an underwriter. If it passes our sniff test with the way we do it with the Analyzer 3.0, chances are it's going to pass the sniff test for the lender. Number 5, negotiating deal. Now, you can't really negotiate a deal unless you have valued the deal and you understand what moves the needle. But in order to negotiate the deal, you need to have key negotiating points. You need to have an idea what the business is worth. You need to have an idea of what the range is going to be on the low end. You need to know exactly what you could offer, what the medium is on the SDE side or on the adjusted EBITDA side, if it is north of $500,000. So you need to understand what are you willing to give up, right? If you want the seller to carry anywhere from 5, 10, 15, 20%, well, they're not going to carry the paper, or they're not going to do seller financing and give you the working capital. Let me ask you this. Are you stuck trying to figure out how to actually buy a business? You looked, and you don't know how to actually make an offer, talk to the lender, what is the multiple, what are the industry specifics, what are the nuances of buying a business, when do you open escrow, do you have earnest money ready, or when do you give it, etc. I'm sure you have questions. I have the answers. If you want to connect with me, if you're in the process of buying a business in the next 90 days, we need to talk. Drop me a comment below and shoot me an email. The email address will be up here and at the description section of this video. I would love to help you with your buying acquisition journey. So are you going to ask them for seller financing, or are you going to ask for working capital? Are you going to ask for a 3-time multiple of SDE if it has the medium, or are you going to ask for 3.25 because you know it's going to be a very competitive? Now, a business has been around for 40 years that there's the top 3 in whatever market you're looking at. You know that's going to be a bidding frenzy. And most lower middle market businesses like that don't have a price when they come out. So if you're looking for the broker to tell you what the business is worth, you're wasting your time, because the beauty is in the eye of the beholder, right? If you know what you're looking for, you're going to know exactly what a range. So I usually like to pinpoint a negotiating point. Okay, this is where we're going for, and we're going to fall back 200,000, and we're going to go up to 200,000. So what are the things that you negotiate? You negotiate the purchase price and the payment terms. You can negotiate the transition period and the training. You can negotiate non-compete agreements. Do you realize that non-compete agreements have a monetary value and the allocation of purchase price? You're going to structure the purchase agreement. Now, is it going to be an asset sale or is it going to be a stock sale? Now, if it is a stock sale, it's because there are multi-year agreements tied to the legal entity and you have no choice but to buy the stock. So you buy the equity, you don't buy the assets. So, but in a stock sale, purchase actually favors the seller because the seller gets to capitalize a lot of its benefits and tax-wise. Stock sale doesn't give you the step up on the asset purchases that you do when you actually buy the assets, because you're buying the assets, you're taking from the seller's company into the new co. The new co is your company. So there's all of those things. So if you're willing to compete and you want to play game, you want to appease the seller, and the seller really stuck on wanting a stock purchase agreement, then you have to model that in your offer, because when you're buying stock, you're buying unknown liabilities. Those unknown liabilities are worth what to you, right? What is your range? What are you willing to give up to get the deal done? So once you have that, and you have to understand a good idea of, inside of our group, we have the Deal Analyzer 3.0, which actually helps you spell out all the points. Which is going to be seller financing, no seller financing. It's going to be standby, no standby. You're going to go 5, 10%, 15%. What is it going to take to get your debt service coverage ratio to 2 to 1 or better, right? Yeah, most people want 1.5 to 1. I want 2 or better. Sometimes we go 3 before we make an offer. All of those points go into in every deal that we look at as a pre-LOI questionnaire completely filled out with 25 questions that we have everybody present to our meetings, right? So once you have all that figured out, then you can begin to flesh in the letter of intent. The letter of intent is a working document. Basically, it's a handshake deal with the seller, and we gain the biggest thing that we get is a non-binding agreement, but you also get to take it off the market. Now, some sellers are very shrewd, and they're gonna want to not sign off on an exclusivity provision on the LOI, and they're gonna want to accept other offers. And that's okay. It's what are you willing to negotiate? Now, the financing and the purchase. Now you got traditional financing options. You got bank loans and SBA loans. You can get alternative financing methods. You can actually get an 80, 90% seller financing, and that's only available. Think about it. If the seller is not going to walk away with cash at a close, it's because they trust you. There's something that you maybe an industry insider, an operator, you already own it. The more risk that you present to the seller, the more risk, the more cash at close. The less risk, the less cash that the seller is willing to take. So as you prep the deal, you need to understand what are the gaping holes. What is the SWOT analysis on the business on you and on the business that you're trying to buy, and how do you model that with the financing piece? Because if you bring in an SBA lender, it ratchets things up. It's actually a good thing for an insurance. If you really want to insure the deal, you want to protect yourself, you're going to have another set of eyeballs looking at this deal, right? They're going to really asset test, they're going to stress test the interest rate and the principal payments to make sure how it does under different variable market conditions. Now you also have your due diligence team doing their work, and then to figure out, you got more people looking at it. It takes more time to close. And some sellers don't really like dealing with SBA lenders. Now, if you're working with a broker on a deal, on an HVAC deal that has not been pre-approved by an SBA lender and the cash flow is there, that's a red flag. I would never take a business to market as a business broker if I haven't gotten approved by at least 2 SBA lenders, no less than 2. And I want to make sure that the lenders looked at all the source documentation, all the tax returns, because you know that you're not going to get an SBA loan unless you have tax returns. Now, what we like to do is we do pre-flight underwriting when we're doing the due diligence. We want to make sure that if we're looking at this deal and we have tax returns on hand, wouldn't you just want to vet the deal with an SBA lender before you make the offer? And you want to have the SBA lender say, I really like this deal. So long as everything comes through and I'm looking at the tax returns, it cash flows every year that I'm looking at, and the debt service coverage ratio, it's fine, and every year. So all we have to do is prep you and bridge the gap on the management experience, do a write-up, do the business plan, do the projections, and figure out the licensing situation, whether you have it or not, who's going to stay on, who's going to go. You got yourself a deal. But if you haven't done any of that, what are the chances of you actually finding a lender? Lenders don't want to be coming at the 11th hour. You want to have those relationships with the lenders right away. So What lenders are concerned about is only one thing: risk. How are you going to mitigate the risk? By your solid business plan, by your solid 2-year projections, by putting your best foot forward, by having good credit, by having ample collateral, by presenting the best foot forward. Now, there's going to be an element of goodwill on the deal, okay? So, I know it said a lot. So, step 7 is legal and regulatory considerations. Now, this is a trade business, and in most states, is licensed and regulated by the state that you're buying. If you're buying in California, you're going to be a state licensed in California. If you're going to be buying in Texas, most HVAC is licensed everywhere. And there's a reason that is to protect the consumer, right? To protect the consumer, so the consumer feels comfortable that you're licensed. You're not going to blow up their house by the kind of, see, if you're not going to damage the work that you're doing. It's going to be insured, and you're going to probably be insured and bonded. So there you're dealing with licensing and certifications. You're going to be required licenses and certifications for HVAC. And if you have a specialty HVAC like I do, they're going to have multiple licenses. There's going to be environmental and safety regulations that are coming to play, compliance with EPA regulations, OSHA requirements for HVAC operations, and the like. Number 8 is going to be your transition and integration. That comes towards the end. How are you going to, I'm assuming that you have you and your team, you and your investors, you and your partner coming in, right? And you're going to inherit, you're going to buy the assets of this business. And guess what? Human capital is an asset. So you're going to integrate, you're going to bring in those employees into the fold, into the new co, right? And how are you going to ensure a smooth transition? Communication is key. Over communicate. If you're over communicating and really in charge of your timeline, you're going to give assurances to the seller. You're going to make the employees make less antsy, right? If you're wobbling, if you're not moving on solid ground, if it appears like you don't know what you're doing, that transition is going to be a pain. So number 1 is you're going to want to retain key employees. Absolutely. Do they have to stay with you? No. You want to incent them to stay with you. And there are multiple ways to do that beyond the scope of this video. You also want to communicate with customers and suppliers properly. I would say once you have a fully executed APA and SPA, when you know that there's the finish line, you're going to be able to close this deal, you'd really want to keep everything confidential. Now, operational integration. Now, whatever technology piece you're burning, if you already own an HVAC business, you're integrating this one. If you don't own one, how are you going to be able to take all the pieces and all the tools and roll them into your standard operating procedure manual, your SOP manual? Are you going to be upgrading or maintaining existing equipment? What is the plan? Is there any CapEx plan, etc.? So there you have it. So buying an HVAC business, it's a great business, but you want to know what to do. And if you have in doubt, reach out to me. Let me help you. Thank you for watching. At a time, I'm giving away my cash flow calculator. We call it the Deal Analyzer 2.0 and my business buyer's checklist. You need to have them both if you intend to buy a business. Right now, they're my gift to you. All you have to do is follow the links below to download them.